This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Not many people go from 3 million to 300 million in 3 years. Our guest today did just that. I'm looking forward to diving in and hearing how he did that. I know you're wondering, Nick, welcome to the show.
Thanks. It's an honor to be here.
Yeah, I want to dive into your business though a little bit. Give us you went from what I read, a half dozen employees to 30, in the last year. And so give us a little bit about your business and, let's dive into how you did that and why.
Yeah, sure. So we're a very, mission-driven organization, a very kind of values-driven organization, a very spiritual organization. So we have kind of a radically different, structure to our private equity fund. We have no fees whatsoever. 100% of our profit goes to our investors until they've gotten a full return of capital. And then it's a 50-50 split after that. So I think we really, put the needs of our investors ahead of our own, in the mathematical kind of sense of the word. 5% of the profit from our organization goes to charity. We built a school last year. So I thought that was like the coolest thing I've ever done in my life. Found an abandoned 40,000 square foot office building and did an adaptive reuse, converting it into a school that my children now attend, along with hundreds of other kiddos. 5% of our profit goes back to our staff in a profit share. In all that we do, we're asking ourselves, how do we create more real tangible value for our tenants, for our investors? So just how do we create as much value? And I think that relentless focus on value creation on service is what's allowed us to grow so quickly, to raise capital at a time when it's been challenging for some people to raise capital, to find really good deals, because I'd say we're willing to work on the difficult problems that most people aren't willing to touch. We bought a 100 unit townhome subdivision a few months ago where 50% of the units were in rent collections, and any assumption you could make about that community is probably accurate just with that one piece of data. Like we own our property management company, we're vertically integrated. You can't hire a third party property management company to take over a property like that. That's something where you have to have a servant's heart to dig into something like that. And we've been able to turn that place around so fast. It's unreal, just by going door to door and saying, listen, we're so sorry that the previous property management company failed you and did not help you stay accountable. And now you're, $7,000 behind on rent. We're here to serve you. There's no judgment in our hearts. If we can help you get caught up, great. If you decide the best thing for you is to have a clean slate, you can leave anytime. We'll give you a refund of your security deposit, a prorated rent refund. We'll forgive your back debt. Whatever we can do to help you get a new start and move on to the next stage, whatever that looks like. And there doesn't have to be this oppositional relationship between a property management company, between a landlord and the tenant. I think if you really truly care about people and you really want to serve people, everyone's heart opens, and all these barriers we put up just go away, and you're able to achieve incredible things. And the crazy thing is, doing the right thing, it turns out it's an incredibly profitable thing to do. We paid $11.1 million to that particular property. I mean, we've never sold anything. We target an indefinite hold period. That's, we've been doing this for 12 years. We've never sold anything, but we probably sell that today for, 14 or 15 million. So that's like a 1,000% AAR or something like that on that deal, if in some sort of hypothetical sales scenario. So I don't know. So there's a couple, anecdotes or whatever to give you a little bit of background about our organization. I think the values that have really driven us to where we are today.
I wanted to highlight some of the things you mentioned around the structure, and and is this every deal? Are you doing single asset funds, or are you doing large multi-asset funds? Clarify that.
Yeah. So it's all about incremental improvement and growth. So we manage our company the same way I would manage like an agile software development project or something of that nature. So we iterated towards success. We had kind of a small portfolio to start with, and we were at this point that I think every real estate investor gets to, where they have enough properties that it's a hassle, but not enough that they really have the economies of scale and levels of management and stuff that it seems like the pot of gold at the end of the rainbow is awfully far away. So we said we really have three options. So we can hire a third-party property management company to manage our properties. We're self-managing, 20 properties or something like that. We could sell our properties and become, LP investors in other people's ventures, or we could start a property management company and do third-party management for other people, and that would help us kind of race to the economies of scale that we would need to really build a team. And I love building teams. So we started the property management company, started doing third-party property management, just over delivered for all of our third party property management clients. I think most people, most of the time, hate their property management company. It's just something about the way I think there's a disalignment of incentives in most property management kind of contracts and stuff. But it's not hard to win business. And then those people that we just over delivered for, those became our first investors, our first partners. And we said, okay, we've turned around this property that was failing, and we've made you a ton of money and or saved your bacon. Like, would you like to come in and invest with us on this apartment building we want to buy here? And we started doing joint venture partnerships. And until we had so many of those going that it started to become, I think we had like 5 different, JVs under contract at one time. We're like, this is getting kind of ridiculous. So we launched a private equity fund, and now we've had, multiple rounds of that private equity fund, and we don't get too fancy with it. So, all of our investors, they put that money into a bucket, and then we deploy that capital over time, refine that structure I just described, where there's, no fees. We don't take any profit until our investors get a full return of capital. And then a 50-50 split after that. We target an indefinite hold period. It's a BRRRR business model. So instead of targeting a sale, we target a cash out refi to return capital to our investors. It's tougher. It's easier to sell than it is to refi. But if you can get to that infinite rate of return where you have no money in the deal, and then you can roll that into the next deal and the next deal, you're able to exponentially grow your equity. And this is the business model that we've been using, over and over again, at first with our own, personal portfolio. And then when we decided to start working with investors here just a few years ago. So as we've grown, we've pulled more legs of our empire in-house. So we have in-house full-time maintenance staff, in-house full-time facility staff.
Sure. Speak to the investor that works for, like just like an infinite hold period. Obviously, many will ask about, when obviously do I get my funds back, and it sounds like you get that as well. And you're looking for that refi to be able to do that. Just talk through that a little bit about what kind of investors does that work for, maybe some of the typical questions, that you would get from investors on this kind of structure.
Yeah. So we think of this as a generational wealth vehicle, essentially. This is the kind of thing that your children will inherit. And people do often ask, okay, how do I get my money back? Well, you get your money back actually quite quickly on the front end of the deal. And then at this point, you have to ask yourself, I have all my money back. I keep getting these checks. If I were to cash out of the deal, so to speak, if I were to sell my remaining equity in the deal to someone else, you're going to have like a tax liability event associated with that. You're going to have a capital gain, and you're going to have to recapture depreciation, and you'll come out ahead, but it's not going to be a huge difference. We joke, why would you ever want to kill the golden goose? And we're Black Swan real estate, so it's a fun metaphor to use there. So the investors who get it, like they are all in. We are their favorite investment vehicle. Investors that are looking for, kind of a short-term play, and they're nervous about being invested in something for the long term, we're not a good fit for them, and that's okay for us. But this is the kind of thing that you would pass on, to your children. And at some point we will sell. At some point we will get, an offer we can't refuse from Blackstone, and we'd be remiss not to accept such an offer. But we're never targeting a sale. I mean, we get offers, all the time, but I don't see us ever really listing our properties.
Wow. No, that's incredible. Just to think through that growth and just holding on, forever and not ever planning to sell. Yeah, that is, it's just a different business model than, but it sounds very interesting. I love the give back as well. Just dedicating the 5%, going to charity and even back to the staff. But you also mentioned at the end that, you recently did a webinar but about this Silicon Valley Bank collapse. And,
yeah.
And I know we're probably a week or so behind that actually happening at the moment, but I know there's people that probably still hadn't even heard about it. And so I'd love to just, you to be able to share a little bit about what that means to you, what that means, what you feel like it means to the real estate business, or things that people, our listeners, active or passive, should know about that event. And unfortunately, we won't be able to spend a ton of time there because I want to get to a couple other things, but I wanted you to be able to share about that, especially since it was fresh. You just did a webinar.
Absolutely. So, if people haven't heard, Silicon Valley Bank, it just collapsed. They had purchased a bunch of 10-year treasury notes in, 2021, $127 billion of 10-year treasury notes. And as interest rates go up, the value of assets goes down. Interest rates go up, the value of assets goes down. And that could be, real estate for people listening to this podcast. As interest rates go up, the value of those assets goes down. And this bank, this poor bank, they had gone from 20 or 50 billion in deposits to 200 billion in deposits through COVID. They didn't know what to do with it, so they put it into what should be kind of the safest mattress to put cash into, and those are long-term U.S. Treasury bonds. But every time the rates went up a quarter point, every time the Fed hiked rates a quarter point, they would lose $1 billion in the face value of those bonds. Because if I write you a bond today at 1% and I write you a bond tomorrow at 4%, and then I need to sell that bond on the market at 1%, no one's going to pay face value for that bond. They want a discount on the value of that bond that's now at a lower rate. And fortunately, I think the Fed has done a masterful job of making sure that the U.S. gets its pound of flesh, and a bunch of people lose their money. So all the investors are wiped out, but that none of the deposit holders are wiped out, which gives me a lot of faith that things are going to be okay from a broader perspective in the U.S. economy. I don't see there being any kind of big, national run on the bank. Fortunately, so we have about 20 million in cash right now. We already had our money sitting in 4-week treasuries and T-bills, which I think is a very safe mattress to put money in. Being short-term T-bills, they don't have that same problem that Silicon Valley Bank had. But I think that none of this should be a surprise. Every time there's an economic cycle, the Fed raises rates until something breaks, essentially, and they don't know what's going to break. I don't know what's going to break, but like in our educational webinars, we talked about how something would break soon, and it was just a question of what it would be. We have prepared ourselves for that by we have all fixed rate debt on our entire portfolio. So a lot of real estate syndicators out there right now are in a challenging spot where they got a bunch of variable rate debt in the last few years. But we knew that rates were going to go up, and asset values were going to go down, and people would be kind of in squeezed there. And if you had long-term fixed rate debt, you might be able to weather that storm just fine. And if you had variable rate debt, you might be in a challenging spot. So my present self thanks my past self that we made the hard decision to get that kind of higher rate at the time fixed rate debt versus the lower rate variable rate debt. And this is going to hit every industry. So 6 months ago, the UK pension fund system went insolvent, and the UK government had to bail it out for a period of time due to this exact same issue. They had sovereign debt. The UK pension funds had sovereign debt from the UK government. Rates went up, the value of those bonds went down, and they were leveraged. So they had debt against those bonds. So they're doubly squeezed in the same way like a real estate syndicator is kind of squeezed right now by higher interest rates where their cash flow is going down. They might be negative cash flow. And if they were to sell that asset's probably worth less than it was when they originally paid for it. This could hit the oil and gas industry. It could hit any sector of the U.S. finance system, anywhere where there's a lot of debt or a lot of assets, a lot of capital intensive industries where there's been downward pressure as a result of that. So I think that anyone could have predicted that this breaking point would occur, and it would occur sometime in the not so distant future. I don't think anyone would have predicted Silicon Valley Bank collapse. And in fact, the crazy thing is there's nothing wrong with Silicon Valley Bank. They just had deposit holders that were unified and could act very quickly to execute a run on the bank. $42 billion was withdrawn in 3 days. If it was like a bank serving farmers and not tech private equity funds, I don't think farmers would have drawn down $42 billion in 3 days. So I think that bank was uniquely susceptible due to their concentration of very specific customer base that's fast acting and responsive. But I think that there's more to come. If I'm a big believer in seasons. I think that this past weekend is the winter solstice. I think that we're halfway through winter, but January and February are yet to come. So things they're about to get worse, but spring is just around the corner. I think we can see spring. I think a year from now, interest rates are going to be lower than they are today. I think I can say that with absolute certainty. That's not a prediction anyone would really dispute today. And I think that we can plan and prepare to plant for when spring comes, knowing that there's going to be, and the next year is going to get much worse before things get better in every industry, and particularly the case in the syndication industry. When I was just at the Best Ever conference, they opened the conference with the statement, we suspect, or it was a question, who here is scared that they won't survive until 2025? That was what they opened the conference with. And there was a lot of doom and gloom at Best Ever. I didn't talk to a single syndicator who had a rosy outlook for the next year. But if you've prepared for winter, if you've stored up your harvest, we've amassed the largest war chest of cash we've ever had. I think you can be well positioned for the rest of the winter here.
Just a couple of things that as from what you just said, right? How is that changing what you're doing, right? Or you mentioned you're piling together this war chest of cash, right? Maybe you briefly mentioned it a minute ago, but I wanted you to make it clear again as far as where are you keeping that cash? So it's like you're going to be able to get it, right? Where are you putting that? But then also, how is this changing what you're doing, buying? I know you don't want to ever want to sell. We learned that from the last episode, but what's happening and how you're buying assets moving forward, or even over this next 12 months.
Yeah, I'm an open book, and I hope I can share a few tactical items that are just
Please.
gold nuggets anyone can take away. I hate podcasts; they're all fluffy stuff. So, a friend of mine many months ago had two observations that the yield on 4-week T-bills had gone up 100-fold in the last year. So this was last fall or something like that. It was north of 4% at the time, and he also noted that as asset prices fell, it's possible that the financial system could be impacted by that. So any assets that a bank has on their books, I don't think anyone would have predicted exactly what happened at Silicon Valley Bank. But if you go listen to our webinars from April 2021, we said that the Fed was buying mortgage-backed securities and buying treasury bonds, which pushes down the rate. And so you don't have to be any kind of genius to say, okay, at some point in the future, the rates are going to go up on so that like 30-year fixed mortgages, all mortgages, and the rates on 10-year treasury are going to go up, and they're going to go up a lot because no one had ever seen this type of asset buying program before. Does that make sense what I just said there, Whitney?
Yes.
Yeah. So we were saying that in April 2021, and we have a lot of cash, a fair amount of cash, flowing through our hands, and we're over FDIC limit. So we use a sweep account where it does interbank lending. So you get a small rate on it, a couple points or something like that today. Not huge, but theoretically what it does is it takes your account and puts 250 pieces of your account in other banks up to 250K. So theoretically you're assured if you have more than 250K in the bank, in the event of a bank loss, you wouldn't lose anything. We aggressively leverage real estate trust accounts. So if you're not using a real estate trust account, you should be. Let me just say that you should be. And those accounts are really special accounts that are especially enshrined in the U.S. banking system. They are exempt from FDIC limits. So all of your rent income, if you're there's a million ways you can structure it, but if you are managing money that's other people's money that's real estate oriented, so let's say you have security deposit accounts, rent income accounts, anything that's not basically like an operating account for an apartment building, you should be running that through a real estate trust account. And you are now exempt from FDIC limits on that account. It's kind of a hassle to set up. The banks don't love it because of its special status, but you should absolutely be using a real estate trust account. That's the best practice.
And just something, and we're going to have to move on, unfortunately, but just something very practical. Is that something they can find at most banks, or how to just give them something really practical? How do they find that type of account?
Yeah, and then the biggest one, I'll just really briefly. So every week we put 25% of all of our liquidity above and beyond kind of what we need for the next week into a 4-week T-bill. So every week we can get up to 25% of our liquidity out of a T-bill as cash in a worst case scenario, like 6 days away, but probably just a few days away. So it's kind of cumbersome to get going, to get it going into the 25% aliquots. But once you're there, I mean, we have a modest amount of money in any specific depository organization. The vast majority of our wealth is of the cash that we're holding for investors for ourselves is in T-bills, generating right this second like a 4.7% return. And it's in the safest mattress in all of capitalism. So that's something we've been doing for quite a while, long before the Silicon Valley Bank collapsed, because we feared something like this could happen. We never would have predicted that exact thing. Just we thought something bad is probably going to break soon, because that's how it works. That's how it works every time. It's very predictable. What's the safest strategy we could execute to protect this mountain of cash that we're building, preparing for January and February, and the metaphorical January and February, the late season winter to come.
Okay. No, I'm grateful for you just diving in there. I think it's so helpful to the listeners. At least many have probably never heard of something like that, or just that option, or, thinking that way. And so I just love it, being able to expose them to people like yourself that are doing things differently, but you've researched this and and why you're doing it. But I wanted to jump to a couple other things. I didn't want us to run out of time. And because I know I get questions about this personally all the time as well. I know you have grown a lot over the last couple of years, specifically from a half a dozen to 30 employees, 3 to 300 million. That doesn't happen by just, sitting on your hands. Right. And so give us a couple of details of why did that, you said you've been in business over the last 12 years. What happened 2 years ago or 3 years ago, or what happened that all of a sudden the jets went off and, you sprung forward in a massive way?
Yeah. So certainly the biggest kind of turning point was stepping back from my tech career. So we'd been growing just organically, with real estate as kind of a side hustle. And then real estate became our full-time main thing. So I stepped away from my day job in tech. And then a year later, when the pandemic was really roaring, my wife also stepped back from her career as a physician. So we're both, full-time in the real estate business. And I had successfully built some tech startups before, really focusing full-time on the real estate business. So that gave me just some experience of what it looks like to hire a lot of people, to grow very quickly. But we built our property management company. That I think of us as a property management first organization. Our first hire was an admin assistant hire who has eventually kind of grown into our director of operations. Our next hire was our director of growth. And this is a person who had a tremendous amount, is a former Marine recruiter. So a tremendous amount of sales, and someone who is an expert at hiring people, at judging people, assessing their skills, their strengths and weaknesses, where they could fit in the organization. Because we knew we'd have to hire a ton of people. So the second person we hired was a person who would specialize in hiring. And then over time, we've organically built out, a leasing team. So we have over 1,000 units that we manage with our in-house property management company, and we've got tons of showings and leads that we need to respond to. We have a real estate sales team. So there's about we're in the top 1/3 of 1% of sales teams at Keller Williams. That's where I hang my real estate license. I'm a licensed agent. That's a huge income source for us. And our property management company, well, it's not very profitable. It does pay our salaries, which I find a lot of syndicators, they love to rely on third-party vendors. And it's easier to do so. It's easier to hire third-party property management and third-party maintenance and third-party cleaning, these sorts of things. But when you have people on payroll, like when we go to do due diligence on an acquisition, we have the ability to bring our leasing agents and our maintenance guys, and they tell me how much they can rent it for. I'm not throwing numbers into a spreadsheet, hoping we can hit this number. Like the person who just showed 10 units today, they can tell me exactly how much they can get for that unit. And if we renovate it to this standard, how much they can get. And if we renovate it to this standard, how much can we get? With absolute certainty, they can tell me what the number is. And the maintenance guy who's going to be the one turning a wrench on that property, he knows exactly what it's going to cost to maintain that property better than any kind of formula could ever tell me. So the real advantage to bring those functions in house, it's not easy. It's not fun. It's
Right.
a lot of work to manage and lead a team like this, and it's not even profitable. But you suddenly have superpowers that other people don't have. Where in our last podcast we talked about, we bought an asset that was at 50% rent collections, a 100-unit townhome subdivision. You can't hire third-party management to take on a project like that. But when you own the property management company, all of a sudden you can take on the deep value-add projects that no one's willing to touch, and you can do it with absolute certainty. So we take every penny of cash flow that we get out of the business and we put it right back into salaries. And that's how we've been able to grow our team and scale our team so quickly. Is my wife and I, we're not taking a ton of money out of the business. We're doing great. We have a comfortable life.
So was the big thing then, like you and your wife leaving your JOBs, say 3 years ago, and then you're able to focus completely on the business, and that's when you really took off. You'd done some stuff in real estate, is that 3 million, then all of a sudden you have you're able to just focus completely on it. And you went from a half a dozen to 30 employees last year. And so speak to just the growth internally. Like there's other growing pains, right? That happen, like you're experiencing growth. We've done it as well. We went from, I don't know, me and then my business partner to like 60 employees, pretty quickly. And it's just like, there's other things you didn't expect that were going to be problems, right? Or growing pains, which are good growing pains, but still there's a lot of learning that has to be done there. Speak to some of the growing pains maybe that you all have experienced growing that fast, because it looks all rosy on the outside, right? Everybody just wants to be like you, but then they don't see all the long nights or sleepless nights. But what are some things that you all have had to grow through by hiring that many people and gaining that much real estate under management that fast?
It is not all rosy. That's for sure. It's a tremendous amount of work. But here's the thing: if you're willing to do the hard work that other people are unwilling to do, you're going to be extraordinarily successful. There's a lot of people out there trying to work a 4-hour work week, trying to build a team of third-party vendors and VAs. And if you lead a team, I believe that an elite, high-functioning team is at the core of any impressive human endeavor that's ever been achieved. And so that's exactly what we do. So we relentlessly focus on building the team. We do a tremendous amount of cultural team building. So every Monday morning at 8 a.m., we get our whole team together, everybody, and we dance and we measure our team's happiness. So everyone has to submit a anonymous survey on a scale of 1 to 10. How happy are you? How much energy you have, and how valued do you feel at the company? And I need to know, is my team struggling right now because we just took on a really tough project, or are they super energized? I spend probably about 50% of my time just coaching my team, just leading my team, about 25% of my time being coached, about 25% of my time working in the business, doing actively, being the hands and not the head, so to speak, in that metaphor. But we've had to hire a ton of people. Not everyone's been a perfect fit, and we've had to figure that out as we go. We've hired people that in general have no real estate experience whatsoever. I find when we hire people that have prior real estate experience, they have a set of expectations that makes it very hard to retrain them. I prefer getting kind of a blank slate. So, for example, our construction director, he's running 56 job sites right now and a maintenance team of 7. And most people would say that's crazy. How can you have one person juggling all those balls? Well, he had worked for another entrepreneur, successfully opening coffee shops for that entrepreneur for many years, and successfully opened, I don't know, 4 or 5 coffee shops over the years, and hiring a team and building, middle management and building inventory and figuring out all the processes required to build that coffee shop and get it going. Well, the kind of person who can do that, they can build a maintenance team. They can hire and manage, maintenance people, and a competent manager can manage things in any industry. And I can teach them construction. That's an easy thing to teach. But the leadership skills to lead, it's tough to manage maintenance guys and cleaners. It's a tough management gig, and it takes a certain kind of person to do it. We love hiring people with leadership backgrounds. So our one of our leaders, he had previously managed 13 GNC stores, and like our region of GNC, and GNC is downsizing. They really struggled through COVID, and we hired a fixer for Marriott. They would travel around the country during the peak of the pandemic. We hired them. Talent was just on a steep sale at that time, and we didn't even necessarily have the salary dollars to hire these people when they came along. And we didn't even necessarily know what the heck they were going to do. Like this fixer from Marriott, she was our first hire as an admin for me. It was ludicrous. Like, she was so hopelessly overqualified for the job, but we knew this was a rock star and she is going to perform. And all these people are rock stars. So if I get a fine service experience at a nice restaurant, I'm gonna offer that person a job. I'm gonna keep going back to that restaurant and keep offering them a job until we hire them. It's not all sunshine and rainbows. You have, I call them drama llama stampedes, where this staff person has a issue with this staff person, and there may not even be a real issue. Like, just somehow word gets around or something. You just have to step in and get them together and say, hey, what's going on? Let's fix this right here, right now. So this, small problem doesn't become a big problem. And managing cash flow. So we keep 1 year of burn in cash on hand. So we can 1 year of payroll, basically. And that leaves us feeling very bold to hire people on a go-forward basis. So most people, I think, they struggle when they look at their payroll in a high-growth organization, because they say, hey, I don't have enough revenue to pay my staff, which is almost always your number one expense. So I can't afford to hire another person. But what you're thinking isn't right there. So if you hire someone, they had better increase revenue or reduce expense by an amount equivalent to their total payroll cost, or you shouldn't hire them. You've made a huge error. You're a bad leader, or you hired the wrong person if that's the case. And so we have check-ins at 30, 60, 90 days. How are they doing? Are they excelling? And financially, are we increasing revenue or reducing expenses, in amount at least equal to their salary? And if so, we're good. And then by having that year of payroll in cash on hand that we kind of keep as a buffer, we know we can make all kinds of mistakes. We can hire, one of my coaches says it's like drawing cards. So sometimes you draw an ace, sometimes you draw a jack. Like, yeah, it's good. It's a face card. It's not an ace, but it's still great. Sometimes you draw a 2 and you got to throw it back, and you put together the best hand of cards that you can possibly put together. And shoot, sometimes that 2, it makes your straight happen. Sometimes you get someone that just really complements your team and you're able to get them to excel. But sometimes you gotta hand that card back in and draw another card, and just know that that's part of the process. So those would be some of the lessons learned, some of the
no, it's incredible. I appreciate you mentioning, just like you found some amazing people and you didn't even know exactly where you were going to put them, but you knew they had valuable skills, right? I mean, they had done it, right? And actually they had skills that are really hard to teach, right? You could teach them the soft skills, or like you said, construction, piece specifically. But man, to go be a great leader and to lead teams and to lead, and that's hard, right? And usually somebody has to do a lot of that through experience. And so, speak to quickly though, how are you finding these people? I get that question all the time as well.
So you can go put up a listing on Indeed, and you can get resumes, and we do that. We have hired skilled people that way, but the best way to hire is through referral. So at our 8 o'clock meeting where we have our all hands meeting, one of the things that I do is I say, who do we need to be in conversation with? Please note, I don't ask who's looking for a job, because you don't want to hire the people looking for a job. That's a selection bias working against you, that they're already apparently not fit to be employed through someone else. So we want to be in conversation with this person. And almost every single person we've hired, they've stepped away from another job, and maybe it wasn't right for them at that point in time. We're patient. Like when we find a rock star, like our accountant, she was running payroll for an organization of 500 employees. And we said, man, you are a rock star. We've got all of 10 employees right now, but we're going to have a lot of employees soon, and we need someone who can run the payroll. Please join us. And she felt so loyal to our existing employer, even though they weren't really treating her well. And she felt loyalty to the staff and feared that the staff would not be paid if she stepped away. And indeed, that is actually exactly what happened. But a year went by of her telling her employer, I don't think you're making the right decisions. I don't think you're treating me right. I don't think you're treating the staff right. And I'm going to leave if you don't, improve. And she gave him a year of this feedback. And finally, she did decide to step back and join our organization. But it took a year of us just being in very kind, consistent, polite conversation with her, saying, hey, has your situation changed? Because we would still love you to have, love for you to come join our company. I think most people, that might seem weird to them. Like, why would you spend a year following up with someone to join your company? Like, just go put your ad out on Indeed. What else? That's not how you find rock stars. It just isn't. Like, so she was a referral from one of our other staff members who, we said, we need an accountant, and we need a really, really good accountant who's the best accountant you've ever worked with, because employees of your company, they've had interactions with other accountants at other companies before, and her name came up as, man, she always made sure all the numbers were right, everyone was paid on time, and she just stepped up, went above and beyond, worked nights and weekends when she had to. She was amazing. Okay, full stop. We're gonna get her. Like she will be working for our company at some point in the future, and we will need her. And so let's make this happen, whatever that looks like.
And you followed up for a year.
We followed up for a year. Yeah, we followed up for a year. Once a month, we would check in with her. And then finally, after a year, again, very high consistency person, right? So she said she would give it exactly a year. She gave it exactly a year, and nothing had changed. And so she joined us at that time. That's not how my personality works, but that is how the personality of a good accountant works. It's a very
That's right. Yeah, no, that's a great example. I just appreciate you highlighting that and how you found people, how you find great people, and even being willing to bring them on before you know exactly what they're going to do. Maybe I recently hired somebody. I've known this guy a long time. I knew he's a great individual, just somebody I could trust completely, and just always doing what he says he's going to do. Like, I've just seen it over and over and over, and in not in our business, but he was doing something else. And then I said, man, if you ever wanted to come work for us, I'd love to know it. If you're ever looking for something else to do, you'd be a great addition, to us. And so sure enough, he reaches out and says, hey, I would be very interested to, with working with you all. But it was interesting. What you said there made me think of this, because he knew somebody else really well that worked for us. And so he reached out anyway to that person's spouse. He knew them. And he said, I'm looking forward to potentially working with Whitney, but I'm not sure exactly what I'm going to do yet. And this person told him somehow he knew this. And because like I said, his spouse works for us. And he said, well, I think Whitney will often hire people and then find a good place to put them, like hire great people and then figure out what they're going to do. So that resonated. And I can't say I've always done that, but I do like you
don't always do either.
I loved your desire though, to find somebody that's, amazing and say, you know what? Like, I'm just going to stay after them and put the time in and, keep going till they're ready to come work for us. But I think that says a lot about, you all as well in pursuing that person. And so anyway, tell the listeners how they can get in touch with you and learn more about you.
Yeah. Anyone here can go to meetblackswan.com, meetblackswan.com. They can block a time on my calendar. If there's any way I can offer you value, they can sign up for our mailing list. Come join us at our free educational webinars. We speak to whatever topic seems like it's going to provide the most value to people. We just did our 2.5-hour webinar on the Silicon Valley Bank collapse last night. We just try to provide real value to people that join our community. And if you want to sign up for our wait list, we don't have any investment opportunities that are available right now, but you can sign up for our wait list for the next investment opportunity that we have available. And just lots of ways to connect with us there on meetblackswan.com.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.